We're here this afternoon with Delphine Quinard, Global Head of Sustainable Finance and Solutions and Global Markets at BNP Paribas. Good afternoon, Delphine.
Good afternoon, Andrew.
And firstly, thank you for your and BNP Paribas support for a Climate Bonds conference on next week. It's shaping up to be a very large event. The theme is focused on green transition. What is the role that investors should be playing to support progress around transition?
Our investors have a key role to play in supporting transition, Andrew. For one thing, they have a great influence over companies' behavior, as we've seen many times in recent years. It's becoming increasingly critical that they take a holistic approach to their investment strategy to decarbonize their portfolio and increase investment in climate solutions in line with the Paris goals. So I think a big part of their role would be around engaging on a common understanding. In that respect, a common understanding is very much needed of what a Paris-aligned portfolio actually means. But we see good progress in the industry. For instance, the Paris-aligned investment initiative with the participation of 70 investors representing $16 trillion of AUM has just published a net zero investment framework for consultation. There is an active engagement with high carbon emitters on their transition plans. Both targets and associated capex needed to transition. That's very, very key. In the bond market, our role is to facilitate the connections between investors and issuers, not only in facilitating investments, but also facilitating engagement. So issuers have a clear understanding of investors' ESG views and requirements and a chance to explain or adjust where necessary. There is a spectrum of investors when it comes to transition. Some are very clear on their transition journey, and some are still working on that and what that really means from a portfolio perspective. We always encourage investors to multiply their discussions and be as transparent as possible with issuers in their assessment.
Delphine, you've spoken about the importance of shared understanding and engagement between investors and their underlying corporations. You've also talked about a couple of large joint initiatives that investors and investor groups are undertaking. But we all know the size of the climate challenge. Is there more that investors could and should be doing?
More could be becoming perhaps a little bolder in deciding what they want to finance. For example, by looking further down the credit spectrum, especially in emerging markets. It would be great to see more investors taking a forward view and being bold in driving this market. For instance, we've been involved in Project Green Kangaroo. We had 3 investors being prepared to link their return to a forward-looking equity index, looking at a transition. And this was a more structured transaction requiring, a little more analysis into the product. Another thing would be to create dedicated transition funds. For some investors, it's not obvious where to place their investments, as they may not fit into traditional green or social funds, for instance. We've seen investors be very flexible in this area before. During the COVID-19 initial, COVID-19 bond response, there were not many social funds, but they adapted very quickly when the need arose.
Okay. Delphine, you've also spoken in amongst all that activity of the importance of CapEx and a lot of the discussion around climate action, climate investment, transition never seems to get to the point around CapEx. Can you tell us a little bit more why you see that as being such a critical indicator?
Yes, absolutely. We expect a surge in volumes for transition finance, both in green CapEx financing and new products addressing industries with high greenhouse gas emission. But for brown industries getting greener and for companies to transform, they will need to invest in very different new projects, which themselves and apply the use of proceeds to new green projects or new developments. So there will be really a new need for funding that gap.
I see. So we've spoken about many of the initiatives and moves that are happening at investor levels and talked a little bit more about the particular implications for industry sectors and industries as a whole. Taking a step back, combining all that together, looking at the future around green transition, there's a number of announcements BNP Paribas have already made in this area. Could you tell us a little bit more about those, please?
Yeah, sure. This is right. We've been particularly proactive in promoting transition via the development of robust solutions. We led all 3 transition bonds this year, being the sole structuring advisor and joint lead manager of a transition bond for Cadent Gas Ltd in the UK, a gas distribution company, or Snam in Italy, or Capco in Hong Kong, a power generator company. We are also promoting the dialogue with the ECB on KPI-linked bonds to ensure the development of this market in Europe. We promote transition in the wide sense of it, beyond the bond market, by supporting our clients' transformations, capital structure transformation, supply chain evolution, and also we are trying to be very active in equity and carbon markets. BNP Paribas is also developing methods that can be used to manage the exposure of loan books and investment portfolios to climate risks in partnership with external organizations. For instance, we've undertaken to develop tools that can be used to align our own loan book with the goals of the Paris Agreement. In 2019, BNP Paribas tested the methodology developed by the think tank 2 Degree Investing Initiative, if you know it.
Yes, I do. So if we put those combinations together, taking a step back in your role at BNP Paribas and looking globally, where do you see the major trends? Where do you see these developments all coming together into the 2020s?
Lots of things actually. We think that banks are bridging, the gap between corporates and investors. So it's an essential role to facilitate clients on both sides towards transition to bridge the funding gap I was talking about earlier on, sustainable finance. And there are some funding gaps, and we need to develop new solutions and think about new type of financing, such as the aggregation of projects or public-private sector association to create new structures, public sector megafund co-investment support to meet investor appetite for climate financing, for instance, like blended finance. But what's really interesting is the collaboration between banks, clients, academics, regulators, and so on, and the fact that we are all moving in the same direction and taking this journey together. We see increased alliances and partnerships in scaling climate finance. I mentioned de-risking public-private blended investment. As a bank, we have evolved in our business models, and our clients are doing the same. Or if not, they will very soon. So we can help each other evolving. So one of the main trend I see is we expect to see more science-led targets embedded in sustainable finance solutions. Through these collaborations, you can really embed the science into sustainable finance, create clarity and transparency to achieve impact. There is a growing awareness of transition finance from all market participants, shape of frameworks, the understanding of the EU taxonomy, what are the right KPIs per industry to align investments with the Paris alignment, the Paris Agreement, for instance. Many still think these methodologies are qualitative, but it's not the case. Thanks to initiatives like the EU taxonomy, we are working towards pure scientific, kind of targets. Metrics and data is always considered a limitation. We actually have a lot of information and data.
Yes.
The question is more the standardization of metrics and universality of criteria per industry and industry-driven targets. So really, the key data and information gaps that are an impediment to climate risk measurement and funding transitions are physical and transition risk data on clients, create a common mechanism to acquire data as well from clients, and a good understanding of the key sector specifics. We think it's very important that each sectors build tools which are science-based. There is none, for instance, as of yet in the ONG or oil and gas sector.
That's right. That's right. Yes.
There is a methodology under development, but it's not yet there.
So if we look back, you've identified particular initiatives that investors can do. You've talked a little bit about the evolving role of banks in transition and the large global institutional investors, the importance of engagement, collaborations, of shared understanding, the need to focus on CapEx as an actual tangible reflection of investment in transition, ultimately by corporations and companies. And you've spoken a little bit about the many specific initiatives BNP Paribas are involved in. Now, that's a long opening to your final question, but the final question is this. Looking ahead at the size of the challenge to get emissions reduction of around 50% by 2030, where do you see the gaps between governments, central banks and financial regulators and the financial sector? Where do you see that those components need to be working harder?
Yes, you're right, Andrew. Each of governments, the financial sector and institutional investor have a role to play. We talked a little bit about the lack of standards of what transition means in practice. Ensuring market integrity is absolutely key to address the drive, the pace of change which is required. I think first at government level, there is a lack of clear and common regulations and frameworks related to climate finance, which creates inefficiencies. Governments have a very big role to play in the policy response and regulation. There is a critical role for policymakers and regulatory guidance on common definitions, frameworks, taxonomies, particularly to prevent greenwashing and to provide clarity to investors and other legitimate stakeholders through consistent market standards and disclosures. So the consequence of not getting transition right is now recognized as a climate risk. And it's what is called the tragedy of the horizon, famously.
Yes.
Formal regulatory development would create clarity and give investors confidence in transition finance. That's the biggest driver of change that we see outside of our organization. But the good thing is the EU is leading the way across the world. For example, with the EU taxonomy, EU climate benchmark principles are setting strong ambitions for the EU economy to transition decisively. This will create opportunities and challenges. And the disclosure requirements, which is coming, is really helping a lot the market to develop. For 2020, 2021, preparation for implementation will be key and something other regions will be able to learn a lot from. Okay. Countries are actually following in this mold and creating similar frameworks, especially in emerging markets, in APAC or LATAM, or with a very positive trend. Some US states as well are combining forces to create a green bond development community. So we are missing frameworks in some countries and at the central bank level, but you can see it in action. And also there is the need for more probably carbon regulation. And this is where governmental action will be decisive. So the government, we talked a little bit at some level, the need of education. Education is a major gap within institutions, but also in terms of across all our stakeholders having the same understanding of what is the impact of climate risk on investors' portfolio, corporate strategy, disclosures, engagement, and so on. So participation to industry forum is critical. We have representations involving task force on carbon markets, global markets, the TEG, TCFD. The very fact we sponsor this conference is just a sign that we think it's absolutely critical, and we are really thankful that there is a CBI conference bringing together, all the market participants. It really, drives this common understanding of where we want to go, what are the issues, how we can help and work collaboratively. At some level, finally, I would say, clients are currently driven more by reputational risk, I believe, more than even regulatory need, and that's a huge driver.
Delphine, there's increasing focus now, not just from the global level, but because of the direction and the transition discussions are taking at a focus now much more at industry, sector and corporate level. Can you tell us a bit more about how far that really is developing from what we've been used to, Paris Agreement, right down to where the actual investments are made by investors?
Yes, we mentioned the fact that clients are driven more by reputational risk now. ESG ratings play a role in assessing potential controversies concerning certain companies. I think equity analysts should build climate risk, climate finance data into their stock recommendations and with long-term fundamental analysis. We see a clear shift in investor preferences for low carbon issuances through negative screening, positive screening, and so on. So at corporate level, there is a lot of analysis being done at present. And on the other side, for instance, if you look at asset managers, there is a lot of pressure being put, such as, for instance, proxy voting practices. Our BNP Paribas asset management arm actually does use proxy voting to invite corporates to go in certain directions. We think that is also a tool to help accelerate corporate transformation.
I see. So it's from the top to the bottom and both sides as well. That's an excellent note, I think, to end this interview on. It brings back echoes from past COP of Fiji's president reminding the world that we're all paddling in the same canoe. So Delphine Quinart, Global Head of Sustainable Finance Solutions and Global Markets at BNP Paribas, thank you for your time this afternoon talking to climate bonds. And also thank you to BNP Paribas for their active support for our conference starting on the 8th. It's been a pleasure.
Thank you very much. Thank you.